Hello and welcome to our latest episode of S&P Global Market Intelligence Live. I'm Brian Scheid. I'm a senior reporter with MI's Credit and Markets team, and I am joined today by Sylvain Leduc, Executive Vice President and Director of Research with the Federal Reserve Bank of San Francisco. Dr. Leduc, welcome to MI Live.
Good morning. Thanks for having me.
Thank you. So we have very limited time today. Thank you for joining us. So I will jump right in. The coronavirus pandemic has certainly upended the U.S. and global economy. Unemployment remains above pre-pandemic levels. Inflation continues to rise. Job openings remain high. Supply bottlenecks persist. So let's say if we're looking at the U.S. economy, how far along are we in the post-pandemic recovery? Where are we on that path?
Yeah, so thanks for the question. Let me go back just to put this in perspective, because I think it's great to start from the previous expansion, which was really the longest on record. And so, over 10, 11 years, we've seen really big increases in employment, increases in labor force participation, shrinking wage gaps across groups. Really like the economy as the labor market heated up. As the expansion lengthened, we've seen like really this big improvement over the past 10 years. And of course, the pandemic upended all that. It really, in terms of employment, set us back, the better part of 20 years. I think the actions of fiscal authorities and the Fed in particular have really helped. And now, we've really made progress, let's say, over the past 6 months. Employment has picked up, as you mentioned, but across all groups. Those at the bottom of the wage distribution still have further to go to reach back pre-pandemic levels. But we've really seen improvement right now. Of course, there's still a lot of uncertainty for the fall with the new variants. And so, as we say here, the pace of the economy is really dictated by the evolution of the virus. And this is as true now as it was earlier on in the pandemic.
So let's drill down on a lot of that. But in terms of monetary policy, so Federal Reserve Chairman Powell has discussed an easing of the historic disparities in the domestic job market as a top goal. So that's something we haven't really seen play out yet. So if we look at the jobs report that came out Friday, that showed that the unemployment rate for white workers was at 4.8%. That's slightly above pre-pandemic levels, but it's well below the 8.2% that unemployment rate we see for Black or African American workers, and 6.6% for Hispanic or Latino workers. So those racial groups are seeing much higher unemployment. Let me ask you this first. Do you see that this racial divide in employment, do you see that closing at all?
So it's interesting. So if you look at your chart, you see that there are gaps throughout most of the time. We've always seen these gaps across groups. And what's interesting is that as the expansions lengthen, we see these gaps closing. And I think that's a great lessons that we've had from the previous expansion. Early on, we've seen, we had employment falling, labor force participation declining, and people thought, those workers were not coming back. A lot of it was just retirements. And what was surprising is that as the economy heated up, we saw these groups in prime age working groups, between 25 and 54, really coming back. And this is really striking for women in particular. So by 2016 onward, you saw women's labor force participation reaching level that you had seen back in 2008 on the eve of the Great Recession. So that's a big lesson. And we've heard this during our Fed Listens tour, a year and a half ago, that led to the change in the monetary policy framework, that the labor supply is a lot more flexible than maybe we thought 10, 15 years ago. So those gaps tend to shrink as the economy heats up. And that's something to really keep in mind.
Let me ask you a follow-up on that labor supply more flexible. What exactly do you mean by that?
Well, exactly that. As the economy gets better, as it's becoming more difficult to hire, you see wages being bid up. And I think what you saw is, particularly, again, the previous expansion, workers that were thought to be unemployable became so, by 2018, 2019. So in that sense, there's flexibility in the labor market you might have not have expected earlier on.
So getting back to the racial divide in employment, what exactly is the consequence here? What occurs if this gap worsens?
Right. So, we're at a time where productivity growth is relatively low. It's surprising because we see a lot of innovation. Productivity growth is nonetheless relatively low. Output growth is relatively low by historical standards. So, every workers that can participate and boost our potential is really important. So to the extent that those workers are employable, and again, the previous expansion has shown that those really, really are, we're leaving money on the table. That basically is impacting the amount of potential output we can grow. And so that's the extent to which it's important. It's important to make sure that those workers are not structurally unemployed, but they can be employed, as the economy picks up, as the economy heats up, that those workers can really come back. And that's important because there's more supply than we may think, and that keeps inflation in check as a result, as there's just more people to produce goods.
Do you think that this is an issue that monetary policy that can really address? I mean, what is the Fed's role here?
Right. Well, see, this is where it's important to study this. It's important to make this distinction between what's structural and what's cyclical, and it's always difficult to do in real time. But we have a tendency often to think, and again, let's go back to just after the Great Recession. We had seen big decline in employment, decline in labor force participation. At the time, people were thinking, well, this is maybe just all structural. We've seen a restructuring of the economy. Those people don't have the skills to really participate in the economy anymore. Maybe we have skill mismatch. And this I think has been proven wrong over time. As the economy again picked up, a lot of what we thought was structural became cyclical, because we've seen these increase in labor force participation across groups, and workers that again were thought to be unemployable became attractive to workers because you just needed bodies for production. And so that was so again, this distinction, this is why it's tricky, and this is why it's important to study it. And I think we have to be open-minded about what's cyclical, what's structural. And I think if you go back 10 years ago and what policymakers were putting down as their expectations for what is maximum employment and what's the natural rate of unemployment, you saw those declining. The natural rate of unemployment, or U-star, kept declining with the recovery. And so the good thing at the time was that policymakers were kind of flexible, were open-minded, and were revising their expectations as the economy was improving.
So we also see an educational divide here. The jobs report showing that in July, with at least, workers with at least a bachelor's degree had an unemployment rate of 3.1%. So it's relatively low. But for workers with less than a high school education, it was over 9.5%. So we're looking at 3 times the unemployment rate. Why, in your view, has this pandemic hit less educated workers hardest?
Yeah, the pandemic, that's the lesson, right? The unequal impact of the pandemic across groups. I think what's interesting is that if you look at recession, typically it hits the manufacturing sector much more in service. So the services sector typically is not impacted that much by a recession. This time around, it's completely the other way around, right? It's the services sector where you've seen the big drop in activity compared to manufacturing. And what's happening in the manufacturing sector is that it employs lower skilled workers much more than in manufacturing, in the services sector. You have more minorities that are employed in the services sector. And so as we went into lockdowns, people refrained from high contact areas, in particular restaurants and hospitality, what you see is the impact on those minority groups and women in particular, and those with less skills and less education that have been much more impacted than other folks. Those working in this area, for instance, in the Bay Area, who were able to work remotely and keep their jobs. And so I think that's the main difference between this recession and previous ones.
Do you? So yesterday we got the JOLTS report out of the Labor Department, and that report showed there were 10.1 million job openings. That is a record high at the end of June. So if I could just get you to speculate, why aren't these jobs being filled?
Right. So many factors right now. I mean, I think we can't forget that childcare responsibility is still important. Schools are reopening right now, but not everywhere. And if you have, if you want to go back to work and you still have childcare responsibility, it's even difficult to find people to come and sit your kids at home. It's much more expensive than it used to be, for sure. So that's certainly one factor. It's the as we mentioned before, the economic recovery is still uncertain. What's going to happen in the fall with the variant? Are you taking a job that's going to, and then you're going to be let go in a few months? You need to make plans for this. If you go back, you need childcare. Is this going to work out? What if you let go after? So I think there's still a whole lot of uncertainty that's making people maybe a bit more hesitant to going on and taking on a new position. And then UI benefits, it's still very high, and potentially holding back some people to go get jobs. Although the analysis that we've done here in San Francisco suggests that particular effect is relatively minor compared to the other ones.
Can you get into that research, though? I know that is an idea that this idea that unemployment benefits are keeping workers out of the workforce. That is something that Chairman Powell has pushed against. So can you comment a little bit more on what you guys found?
Yeah, I mean, we've looked at job finding rates, for instance. How difficult the amount of jobs that people are finding per states, for instance. So we look at the difference across states. And what we find is that's kind of it's not that large. The job finding rate's about the same everywhere. Although the benefits, the federal benefit in terms of UI, in real terms are not the same. So you get the same amount of money, whether in nominal terms, whether you're in San Francisco or you're in let's say Arkansas. But that money, of course, in real term is not the same. And so the benefit is different across states. Yet the job finding rate is about the same. And so, this is the sense in which UI benefit may have kind of a, leads to a reduction in search activity, but the effect is not very big.
So with that, this record number of job openings, with this educational divide we see, the same question for the racial divide. What exactly can the Fed do? What's monetary policy's role in all this?
Well, I mean, our mandate, in a sense, is very strict and very narrow. On the macro side, where we have a price stability mandate, which we understand to be 2% inflation over the medium run, and we have maximum employment. And then, as you know, with the change in the framework a year and a half ago, we pointed out that this is really an inclusive mandate, so that we're really looking broadly in terms of maximum employment. So what we can do right now, given where we are, is we're still far from what we see as maximum employment, and we're seeing price pressures clearly above our 2% target. But our assessment here at the moment is really that those will be transitory and come to pass as we readjust, as the economy reopens and we work out those bottlenecks and other pressures. And so what monetary policy can do right now is keep being accommodative to make sure that we can go back to level of employment that we saw pre-pandemic. Some of those other effects are structural. We can't solve it all. Monetary policy, is not the only lever here to address some of these issues.
You mentioned a word that Chairman Powell likes to use a lot, that's transitory. Can you define that at all? I mean, we're talking about something transitory inflation. Are we talking about months? Are we talking about well into 2022? What exactly is a timeline on transitory? Right.
Well, I think the price pressures we're seeing right now will continue through the end of the year, early next year. I think what we're looking at is those pressure not feeding through long-term inflation expectations, where that would be much more worrisome. So we've seen increases in household expectation on the shorter at the shorter horizon, much less so at the longer horizon. And we know for households for sure that those are more sensitive to salient price increases, food, energy, which have gone up recently. And this is not new. If you go back to the Great Recession, we had seen similar increases in household expectation early on in the recovery at the time when commodity prices were also booming. And then, commodity prices go up, come back down, household expectation at similar movement. When you look at market expectations, I think these have been much more muted, very much in line with what we've seen over the past 10, 15 years. So in this sense, I think that the situation is less worrisome. And I think we'll know much more in the fall about all this as UI benefits, for instance, expire. Maybe there's less uncertainty about the recovery. We'll readjust to the pandemic. And so we'll be able to know much more about the extent of this transitory nature on inflation.
But as inflation continues to rise, as you talked about these price pressures going into early 2022, we also see wage increases. How much is inflation impacting those wage increases? I mean, what is the damage this inflation is doing on the economy?
Well, again, to the extent that so prices are going up, people are feeling it. So in real term, that's damaging to people at the moment. But the important thing for us is that it doesn't continue over time. And this is where we're still expecting this to be transitory as people work out the bottlenecks. And you've seen this in commodities, for instance, like the lumber prices that people were pointing out to early this year have really come down. They've retraced all the increase we'd seen. It's just all been walked back. And so, as these producers were seeing higher prices, started production again, they worked out the gaps. And we should see this as in other sectors as well, transportation being one of them, shipping. We have contacts here in the Bay Area and in the LA area where the bottlenecks we've seen in shipping is expected to be worked out by the end of the third quarter, early fourth quarter. So these are adjustments. The pandemic is a big hit. It's a new phenomenon that we had seen in the past, but people are learning, I think, to work with it, and so in this sense, we're seeing this being a transitory impact.
So I'd like to get into a little bit on income inequality. In the first quarter of 2020, we see these numbers where the top 1% of American households held slightly less than 30% of total wealth. Since the pandemic has raged on, that number is now up over 32%. So the top 1% holds more wealth than they did at the start of the pandemic by this percentage share. So we hear about this disparity a lot, but not a lot about what this means for economic health. So can the ongoing economic recovery be hindered or derailed if this disparity gets worse?
Right. So, those trends, you're showing this from, I think one concern right now is really twofold. I'd say, first, in terms of education, we've seen the impact across groups being kind of unequal. It's much easier for higher income group to maybe supplement the gaps we've seen in education right now. And the second thing that you could worry about is in terms of this being accentuated over time is really kind of automation. So that's one thing as firms maybe have difficulties finding workers right now, and they may be worried about future pandemics or future bursts of the pandemic and may want to protect themselves against that by automating. And this would come to even accentuate the trends that you're showing. Since we know that automation, for instance, is complement to skills. So, when you have new machine, you tend to need high skilled workers to do this, to operate them, which boosts the demand for skills and increase wages and the return to those who have skills. And it tends to substitute for low skilled workers. And so that's one of the concerns with the pandemic as it goes on, that it could accentuate the trend we had seen in the past.
So on a related note, the Fed's monetary policy that's been has been credited or blamed, depending on who you talk to, for this meteoric rise in equity markets and the rally in bonds. And that's putting more money into those 1% households. So, I mean, in your opinion, has Fed policy, we're talking about, near zero rates and $120 billion worth of bond buys every month, has that policy worsened this wealth gap?
So again, if you go back, I think this is where going back is important, because the trend in inequality it's not something new. It's gone on for 40 years, and monetary policy has been restrictive at time, expensive at time, and so it's difficult to find over time a strict relationship between monetary policy and wage inequality. So there's a whole lot of factors, from technology to offshoring, that are underlying the trends in inequalities. Right now, I mean, we know policy needs to be accommodative to support the economy and meet our dual mandate. That has repercussion. I mean, that's for sure has an impact on asset markets. We know when rates are low, asset markets like the stock markets tend to boom, and we know that assets are not held equally across the population. I mean, we know about 40% probably don't hold any assets at all. And so de facto, when the stock market is booming, this has an unequal impact on the wage distribution. So that's certainly a consequence of that can be a consequence of low rates. But low rates are low for different factors, not only because of monetary policy, but also because the situation is uncertain, and investors are flying to safer assets like bonds, and so that keeps rates low and has an impact on other asset prices as well.
Great. Turning from the pandemic a little bit, I'd like to touch on inequality and climate change. So we see all these gaps between levels of education, races, household wealth. Do these gaps all worsen as the effects of climate change worsen?
Yeah, I mean, this is where climate change is kind of similar to the pandemic in a sense. The impact of climate change are highly unequal. We see this across the world to a large extent. The impact of climate is much more pronounced in poorer countries that depend on agriculture, for instance. And those workers that are working in the agricultural sectors, who tend to be poorer, are the most impacted. If we drill down here, I think the same thing will be happening. I mean, we see the impact of extreme weather events more and more. We'll see probably those, at least here in the Bay Area or in California in general, much more in the agricultural sector to start with poorer workers, more disadvantaged workers being impacted the most. It's interesting to cope with with climate change. You also need resources. In the Bay Area, where we're suffering from the consequences of the wildfires in the region. You can have air filter to cope with that, but those are expensive. You can put AC, that's expensive too. And so just dealing with the consequences of climate change on a very mundane level, implies resources that not everyone has.
If I could just get you to sort of really speculate a little bit, but the Fed's monetary policy that we talked about, rates near zero, 120 billion each month of bond purchases. What do you think the economic fallout would have been without that? And then to follow up on that, what do you see as the role between monetary policy and fiscal policy, both at the federal and the state level?
So, without the accommodation, you have to go back a year at the start of the pandemic. Like, markets were really whirled by the start of the pandemic. I mean, there was a lot of uncertainty. I think, we really stabilized market with the actions that the Fed has taken really early on. So that just the stability that the Fed provided early in the pandemic was really key to set up the stage for a recovery once the pandemic was more under control. The accommodation after that, just in terms of supporting the economy, I think has been really important. And not only the Fed, but fiscal authority also, in terms of all the measures that were implemented in supporting small businesses, for instance. I mean, that's one thing we also forget. It's not only inequality in terms of income and households, but you could think about the impact being very unequal across firms. Large firms had a much easier way to deal with the pandemic on average than small businesses were really hit head on. So I think without the support that was provided at all levels, it would have been much, much worse.
There's been a lot of, I don't know, obsession might be the right word, of the timing of tapering. Is there a risk if the Fed holds on too long, doesn't taper soon?
Well, at this point, I think that the discussion, as you saw at the last meeting, the discussions are starting. There's more and more. I mean, I think everyone is recognizing that there's been a whole lot of progress in terms of our dual mandate. And then there's a reassessment of how much is needed going forward. And this will continue through the fall, and we'll see what policymakers decide to do.
Great. I'm going to turn to the audience if you'd like to ask a question. I have a few queued up here. The first one is something we have touched on, but maybe you have some more to say about it. How concerned is the Fed about inflation as the economy reopens?
Right. I mean, we have two mandates: maximum employment, price stability. We've always, we're always very aware and concerned about inflation. And it's something we're always watching very closely. At this point, what we're seeing is transitory movement in inflation. We can't forget base year effect. I mean, we're comparing inflation year on year, and this is often forgotten. But last year prices had fallen with the pandemic, and just mechanically, a whole lot of the inflation we're seeing right now is just the fact that we're comparing higher prices today to very low prices last year. And so this is going to dissipate as we go forward this fall. By August, by September, we should see at least those base year effect vanishing. And then there are the bottlenecks. But the bottlenecks, again, are likely to be worked out over time. So how long is that going to take is not exactly clear. But we're thinking by the end of the year, early next year, we'll see a lot of those price pressure dissipate.
Do you think that the bottlenecks, that issue has peaked? I mean, are we looking at everything easing from this point on? I know we've seen rentals on cargoes go skyrocket recently. I mean, do you think those price pressures are going to be lessening going forward?
I think it depends. It depends on the sectors. So, for instance, lumber prices, as I mentioned, have already come down. So that's where the adjustment has occurred very quickly in this sector. I think in the chip industries, which is impacting the car market in particular, I think those could last longer than were anticipated earlier on this year.
Great. Another question from the audience. Can you please let us know if the work from home economy is going to keep inflation down?
Well, this is kind of an interesting question. I don't think the link is so clear here in terms of inflation. Some sectors, again, will be impacted by this. Maybe commercial real estate in certain urban areas, as people maybe don't have to come to the office as often as they used in the past. So you might see some relative price changing, but I wouldn't think that this would have a huge impact necessarily on inflation.
What do you think the overall economic impact, though, is on that shift from office culture to work from home?
Well, I think that the flexibility is key here. I think we've learned people need flexibility. We've got complicated lives. People have childcare responsibilities. I think the flexibility is probably lets more people into the job market, if anything. And I think that to the extent that companies can adapt and workers adapt to this more flexible environment, we might see more employment going forward, which would be pretty beneficial in terms of economic activity and growing our potential.
Do you see any impact on worker productivity at all?
Yeah, this is kind of interesting because what we've seen is large. If you look at this recession compared to previous one, you see a lot of investment in equipment. Typically in a recession, investment falls across all categories. This time hasn't fallen for equipment, and equipment are, if you think about computers, you have a bigger capital stock, and this would tend to increase labor productivity. At this point, it's not so clear if it's going to be productivity enhancing, because some of it is just duplicating what you had in the office, right? So you need a computer to work from home. You're probably as productive as you were here. You just needed that computer, and companies had to make this investment. So at this point, it's not exactly clear if it's going to be productivity enhancing in the future.
So one last question. Thank you again for your time. This is another question from the audience. What is your view on the potential impact of the Democrats' $3.5 trillion reconciliation package on inflation and the deficit? How big an impact could that have on the overall health of the economy and efforts to reduce economic disparities? So again, we're talking about, fiscal efforts this time. What are your thoughts on that?
Yeah. There are many things in this package. There are many aspects of it, so it's difficult to address them all. I think one part that is interesting to me is really in terms of leave of absence. Providing maybe more means for people on leave, maternity leave, so that people can come back. I think that's really an important aspect. Labor force participation in the U.S. has really stagnated on average over time. If you compare labor force participation across developed countries, and the U.S. is really lagging. Often we have, women in particular after giving birth, leaving their jobs and not coming back, and that's a real cost. And I think the provision in terms of childcare that we've seen in other countries really help that to create this attachment to the workforce. And we've seen, across these different countries, more women coming back after birth. And this is something I think would be pretty important.
Great. Sylvain Leduc, thank you so much for your time, and thank you for joining us on MI Live. We will see you hopefully next time.
Thank you.
Thank you.